Preparing for NN Group Risk Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a risk analyst at NN Group? I am attracted to NN Group because insurance risk affects customers, capital, and long-term financial resilience simultaneously. The role combines quantitative analysis with judgment, understanding exposures, challenging assumptions, and explaining implications to decision-makers. NN Group's scale and diversified insurance operations would provide a strong learning environment. I would bring careful analysis, curiosity, and clear communication, while developing deeper expertise in Solvency II, enterprise risk management, and how risk insights influence strategy and capital allocation. While answering, connect your interest in insurance, risk-based decision-making, and NN Group's European footprint with your analytical skills, ethical judgment, stakeholder communication, and motivation to protect customers and support sustainable business performance. Question 2. How would you explain NN Group's main risk categories? I would group NN Group's risks into insurance, market, credit, liquidity, operational, and emerging risks. Insurance risk includes mortality, longevity, morbidity, and catastrophe exposures. Market risk arises from interest rates, spreads, equities, currencies, and property values, while credit risk concerns counterparties and issuers. Liquidity and operational risks can amplify other exposures. I would assess each category using appropriate metrics, then consider correlations, stress scenarios, controls, and the effect on solvency and earnings. Make sure to cover insurance, market, credit, liquidity, operational, and emerging risks, while explaining their interactions, measurement approaches, governance ownership, and potential impact on solvency, earnings, liquidity, and customer outcomes. Question 3. What is Solvency II, and why is it important for NN Group? Solvency II is the European prudential framework for insurers, designed to ensure they hold sufficient capital for their risks. Pillar 1 covers quantitative requirements such as technical provisions, own funds, and the Solvency Capital Requirement. Pillar 2 covers governance and risk management. Pillar 3 covers reporting and disclosure. For NN Group, it supports disciplined capital management, transparency, and resilience. A risk analyst helps validate inputs, investigate movements, and communicate whether capital remains adequate. In your answer, discuss the three-pillar structure: Solvency Capital Requirement, Minimum Capital Requirement, Eligible Own Funds, Risk Margin, Regulatory Reporting, and how the framework supports resilience rather than merely compliance. Question 4. What is the difference between the Solvency Capital Requirement and the Minimum Capital Requirement? The Solvency Capital Requirement is the risk-sensitive capital level intended to absorb unexpected losses over a one-year period at the regulatory confidence level. The Minimum Capital Requirement is lower and represents the point below which policyholder protection becomes more urgent. Falling below the SCR triggers supervisory attention and a recovery plan, while breaching the MCR can lead to stronger intervention. I would monitor both ratios, explain movements, and escalate deterioration promptly. Be sure to mention that SCR is a risk-sensitive solvency buffer calibrated to a one-year confidence level, while MCR is a lower regulatory threshold, including the escalation consequences of falling below either level. Question 5. How would you assess an insurer's solvency ratio? I would calculate the solvency ratio as eligible own funds divided by the Solvency Capital Requirement. The percentage alone is not enough, so I would reconcile the movement from the prior period: earnings, dividends, market performance, interest rate changes, claims experience, model updates, and business growth. I would compare the result with internal appetite, regulatory requirements, and stress levels. Finally, I would confirm data quality and explain the key drivers clearly to management. Focus on dividing eligible own funds by SCR, decomposing changes into capital, market movements, underwriting experience, model updates, and management actions, then comparing results with limits, targets, and stress outcomes. Question 6. What is an ORSA, and how would you contribute to one? The ORSA is the insurer's forward-looking assessment of its own risks, solvency needs, and ability to execute strategy under normal and stressed conditions. I would contribute by validating exposure data, preparing stress and scenario analysis, challenging assumptions, and documenting management actions. I would connect business plans with capital projections rather than treating ORSA as a compliance report. Strong governance matters. Conclusions should be owned, reviewed, approved, and clearly communicated. Discuss the own risk and solvency assessment as a forward-looking process covering strategy, risk appetite, capital adequacy, stress testing, reverse stress testing, governance, and management actions across the planning horizon. Question 7. How do interest rate movements affect an insurance company such as NN Group? Interest rates affect both sides of an insurer's balance sheet. Falling rates usually increase the present value of long-term liabilities, while asset values may also rise. The net effect depends on duration matching, guarantees, and hedges. Rising rates can create short-term valuation losses but improve reinvestment yields and reduce liability values. I would analyze duration gaps, convexity, hedge performance, solvency impact, and liquidity needs, distinguishing temporary market volatility from structural risk. Cover asset and liability duration, discount rates, guarantees, reinvestment risk, spread effects, hedge effectiveness, and the difference between immediate accounting impacts and longer-term economic effects on solvency. Question 8. How would you analyze longevity risk in a life insurance portfolio? Longevity risk occurs when annuity or pension policyholders live longer than assumed, increasing the duration and present value of future benefits. I would segment the portfolio by product, age, country, and benefit type, then compare actual experience with assumptions. I would review mortality improvement models, sensitivity to one-year or permanent longevity shocks, and any reinsurance or hedge protection. I would also monitor emerging trends, because persistent experience changes can require assumption updates. Mention the exposure to policyholders living longer than expected, annuity cash flows, mortality tables, improvement assumptions, longevity hedges, experience monitoring, and scenario analysis by age, product, and geography. Question 9. How would you assess credit risk in NN Group's investment portfolio? I would assess credit risk by examining issuer quality, sector and country concentrations, maturity, seniority, collateral, and counterparty exposure. Key indicators include ratings, probability of default, loss given default, rating migration, spreads, watchlists, and expected loss. I would stress defaults, downgrades, and spread widening, then compare results with investment limits and risk appetite. For derivatives or reinsurance counterparties, I would also review netting, collateral, and settlement arrangements. Include issuer and counterparty exposure, credit ratings, probability of default, loss given default, concentration, migration, spread widening, collateral, recovery assumptions, and limits across sectors, countries, and counterparties. Question 10. What would you do if a major bond issuer in NN Group's portfolio were downgraded? First, I would verify the downgrade and identify every affected instrument, fund, and legal entity. I would quantify market value, spread, capital, concentration, and limit impacts, including further downgrade scenarios. I would notify the relevant risk and investment stakeholders and determine whether the position should enter a watchlist. The response might involve holding, reducing, hedging, or seeking additional information, but any action should reflect liquidity, recovery prospects, mandate restrictions, and documented governance. Explain immediate validation, exposure quantification, limit checks, market value and capital impact, watchlist escalation, scenario analysis, engagement with portfolio management, and balanced consideration of holding, reducing, or hedging the position. Question 11. How would you perform a liquidity risk assessment for an insurer? I would build a maturity-based cash flow view covering premiums, claims, expenses, maturities, collateral calls, benefit payments, and potential surrender activity. Then I would stress market liquidity, policyholder behavior, spread widening, downgrade-related collateral needs, and reduced asset sales. I would compare net outflows with liquid assets and committed sources, considering haircut assumptions and concentration. The conclusion should identify available headroom, vulnerable time buckets, early warning indicators, and practical contingency actions. Focus on projected cash inflows and outflows, policyholder behavior, collateral calls, stressed surrenders, asset liquidity, concentration, funding sources, liquidity buffers, and escalation triggers within the risk appetite framework. Question 12. What is operational risk, and how would you monitor it at NN Group? Operational risk is the possibility of loss or harm from inadequate processes, people, systems, or external events. I would monitor risk and control self-assessments, incidents, internal losses, audit findings, complaints, cyber indicators, and key risk indicators. I would assess both financial and customer impact, identify root causes, assign remediation owners, and track overdue actions. Effective monitoring is not just counting incidents. It tests whether controls reduce the underlying exposure and whether lessons are shared. Cover failures of people, processes, systems, or external events, risk and control self-assessments, loss events, key risk indicators, incidents, remediation ownership, and the importance of linking operational issues to customer and regulatory impact. Question 13. How would you investigate a data quality issue in a risk report? I would first quantify the discrepancy and determine which reports, entities, periods, and decisions could be affected. Then I would trace the data lineage from source system through transformations to the final report, checking interfaces, mapping tables, manual adjustments, and validation rules. I would reconcile against an independent source, correct the output with approval, and document the root cause. Finally, I would introduce a preventive control, assign ownership, and confirm closure through testing. Mention defining the discrepancy, tracing data lineage, reconciling source systems, checking transformations and controls, assessing materiality, correcting outputs, documenting root cause, and preventing recurrence through ownership and monitoring. Question 14. How would you explain a complex risk result to a non-technical senior stakeholder? I would start with the headline, what changed, why it matters, and whether action is required. For example, instead of leading with model terminology, I might say that a rate shock reduces the solvency ratio by a specified number of percentage points because liabilities are longer than assets. I would show the main drivers visually, separate observed facts from assumptions, explain uncertainty, and finish with options, recommendations, and the decision needed. Emphasize leading with the conclusion, quantifying business impact, using plain language and visuals, distinguishing facts from assumptions, explaining uncertainty, recommending actions, and inviting challenge without overwhelming the audience. Question 15. Tell me about a time you challenged an assumption or finding. In a portfolio analysis project, I noticed that a loss assumption had remained unchanged despite a clear shift in recent experience. I checked the data, reviewed the methodology, and prepared a sensitivity analysis rather than challenging the owner informally. The analysis showed that the central estimate was reasonable, but downside exposure was understated. We retained the base assumption, added monitoring triggers, and improved documentation. The experience taught me to challenge constructively, using evidence and proportionate recommendations. Use a structured example showing the original assumption, evidence that created concern, respectful challenge, additional analysis, stakeholder response, resolution, and the measurable improvement or lesson learned. Question 16. How would you design a stress test for NN Group's solvency position? I would begin with material vulnerabilities identified through risk assessments, then design plausible but severe scenarios such as falling rates, spread widening, equity declines, higher lapses, and adverse longevity experience. I would model combined effects, including correlations and management actions, while preserving transparent assumptions. Results should show solvency, liquidity, earnings, and capital impacts over time. I would also perform reverse stress testing to identify conditions that could breach limits and assess whether proposed actions are credible. Discuss scenario selection, historical and hypothetical shocks, combined market and insurance stresses, correlations, management actions, balance sheet responses, reverse stress testing, and clear interpretation of results against appetite. Question 17. What is model risk, and how should it be controlled? Model risk is the risk that a model is wrong, poorly implemented, based on unsuitable data, or used beyond its intended purpose. Controls should include clear ownership, documented methodology, independent validation, backtesting, sensitivity analysis, change approval, access controls, and ongoing performance monitoring. I would record limitations and compensating actions rather than presenting outputs as certain. If results appear implausible, I would investigate and escalate before allowing them to influence capital or business decisions. Cover incorrect specifications, data, implementation, assumptions, and use, independent validation, performance monitoring, change governance, documentation, limitations, expert judgment, and escalation when models are outside approved boundaries. Question 18. How do you prioritize competing risk analysis requests? I prioritize requests using a consistent framework: regulatory or customer impact, financial materiality, urgency, decision dependency, and effort required. A potential solvency breach or regulatory submission would take precedence over a useful but non-critical analysis. I would clarify the decision each request supports, confirm deadlines, and communicate trade-offs early. Where possible, I would deliver a reliable initial view quickly, then refine it, while escalating capacity conflicts rather than silently compromising quality. Mention regulatory and customer impact, materiality, urgency, decision deadlines, dependencies, effort, data availability, stakeholder alignment, transparent trade-offs, and escalation when capacity prevents meeting all requirements. Question 19. What financial and risk metrics would you monitor regularly at NN Group? I would monitor the solvency ratio, eligible own funds, SCR composition, earnings, capital generation, and dividend capacity. For underlying risks, I would track duration and sensitivity gaps, spreads, equity and property exposure, credit migration, counterparty concentrations, liquidity buffers, lapses, claims, mortality or longevity experience, and operational incidents. I would compare metrics with appetite, limits, forecasts, and prior periods. The most useful dashboard combines indicators with commentary on causes, trends, and required actions. Include solvency ratio, SCR movement, own funds, earnings, investment performance, duration gap, credit quality, liquidity coverage, lapse and claims experience, operational incidents, limits, and emerging risk indicators. Question 20. What would you do if your analysis suggested that NN Group was approaching a risk appetite limit? I would validate the data, calculation, threshold, and timing first, then determine whether the issue is an early warning or an actual breach. I would quantify the driver, forecast its trajectory, and run relevant scenarios. I would notify the risk owner and escalate according to governance, presenting practical actions such as rebalancing, hedging, reducing new exposure, or strengthening controls. I would document the decision, increase monitoring, and distinguish a temporary event from a structural risk appetite problem. Explain validation, materiality assessment, immediate notification, root cause analysis, scenario impact, proposed management actions, documented escalation, monitoring frequency, and the distinction between a temporary breach and a structural appetite issue. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.